So what can we expect from corporate America this earnings season? Joining us with a preview is Ibrahim Gassambe, an equity strategist for Roubini Global Economics. Thank you for joining us again, Ibrahim.
Thank you, Michelle. It's a pleasure to be back.
So Alcoa's earnings, what can we deduce from them as a bellwether for the economy?
Right. Alcoa is a big, like you mentioned, it's a bellwether for the global economy. But most importantly, Alcoa is a mining company. And we all know what's going on with the commodity market. And the lower, disappointing aluminum prices are at the core of Alcoa underperformance, right? So I'm not necessarily allowed to talk for an individual company, but in general, this is what my read is. I'm looking forward to add a bellwether company throughout the earnings season in order for me to gauge the health of the economy.
So not necessarily an indication of what the season is going to look like.
Exactly.
But so far, we have had some pre-announcements of earnings, and they've been very negative. As of last Friday, the ratio of negative to positive has been 6.5 to 1. That's according to Reuters data. And that's the most negative reading since 2001.
Exactly. And this has been part of a trend. But like you mentioned, we are at a record high on that in terms of negative rating to negative guidance, right? But this is part of a scheme where companies kind of drive down analyst expectation into the earnings season, therefore coming with a better result. But overall, the health of corporate American earnings.
So you're not perturbed by that. You're thinking this is the usual company analyst game where companies bring in a lower result, so then we can say, oh, shares beat estimates, and then the shares rally on that news.
Well, I'm not sure whether the shares are going to rally because consensus is just expecting 3.5% growth in year over year in this quarter, and I think the bar is already set low. The scheme is working, right? The question now is going forward beyond Q2 result, what do we expect about corporate earnings? And that's where I'm slightly positive. That's why I'm not really alarmed by the high ratio negative guidance ratio.
So set the bar relatively low and surprise to the upside. But when we look at the fundamentals, last quarter, a lot of the companies reporting did beat estimates, but mostly on the top line, not on the bottom line, meaning that they did come in higher because they were able to cut costs and such things, but their revenue, their sales figures weren't necessarily up. What is that going to tell us? What do you expect for this quarter?
Exactly. So I'm expecting the same performance. I do think that top-line revenue growth is going to be slightly disappointing. The bottom up probably decent, but at the same time, the surprises would likely be much lower than the average surprises that we have seen, right? Again, the stock market is a discounting mechanism, right? It's going to look beyond Q2 numbers and into the next 12 months numbers, right? So on that perspective, you have lower commodity prices, you have higher growth, and you have financial benefiting a little bit from the higher interest rate that we are experiencing recently, right?
So what will be the overall indicator that we can expect from this earnings season for the overall health of corporate America?
Well, I do expect decent number, but maybe given the economic performance already, we've seen payroll data come out last Friday. They were pretty strong. The revisions were really stellar. So I do think that the economy is doing a lot better than we think, right? And therefore, expectations for the second half and into next year are going to be surprised on the upside, and that is going to drive the stock market up.
Okay. Yeah. Driving the stock market up, even though the Fed may be putting its foot off the gas.
We do expect stocks to weather the rise in interest rate. That's because interest rates are rising on the back of stronger growth. And under that scenario, you would expect stocks to do better if growth was still weak, and therefore you're seeing higher rate, you can expect stocks to underperform. But in this scenario where you have higher growth, rising but moderate rising rates, stock market should be performing better.
Okay. We'll see how that pans out. Thank you so much.
Thank you very much. It's a pleasure.
Ibrahim Gassambe, equity strategist for Roubini Global Economics.